Imagine looking at a beautifully painted house, just perfect from the outside. But then you realize the foundation is completely rotting away.
Right, which is a terrifying thought if you're about to buy it.
Exactly. But here's the kicker. You look at the inspector's report, and they haven't actually hidden the rot. Like, they didn't lie and say it was solid concrete.
Oh, let me guess. They just called it something else.
Yes. They legally categorized the crumbling concrete under a section called, rustic charm.
Oh, wow. That's incredibly deceptive.
Right. It's sitting right there in plain sight, but it's totally mislabeled, which, fundamentally alters your perception of whether the building is actually safe. And that is exactly what happens in the highest levels of financial reporting when companies manipulate these tiny, obscure loopholes.
It really is. I mean, the concept of obscuring reality in financial statements, it's perhaps the greatest systemic risk an investor faces today.
Yeah, and we are going to get right into a real-world example of that. Welcome, everyone, to a brand new episode of the Gap Advisors Ind AS Clinic podcast.
Glad to be here for this one. It's a fascinating deep dive today.
It really is. We're dissecting the muddy waters of corporate accounting, and our mission is to translate these really dense reporting standards into those vital aha moments that, protect your capital, whether you're an auditor or an everyday investor.
And it's so much more common than outright malicious fraud. What we're analyzing in this deep dive is a classic case of hiding volatility.
Like the roller coaster brake.
Exactly. We're looking at how a company took an asset that fluctuates wildly with the stock market and they just tucked it away in a quiet corner of their balance sheet, basically smoothing out their earnings to look far more stable than they actually are.
And the best part is that this isn't some textbook hypothetical. Like, we are looking at a suo motu review. The team at Gap Advisors took the initiative to download the actual published documents of a listed entity, entirely unprompted.
Yeah, just to see if the published reality actually matched the strict standards of the Ind AS framework.
And spoiler alert, they found a massive crack in the foundation. We're going to unpack exactly how they found it, why the company did it, and how you can spot it yourself. But before we put this specific balance sheet under the microscope, we need to set the parameters right, the ground rules.
I absolutely do. So for the specific financial statements we're tearing down in this deep dive, the reporting period follows the standard Indian fiscal calendar. So the clock starts on the 1st of April and stops on the 31st of March.
Okay, 1st of April to 31st of March. Timeline is locked.
Right. Anything outside that window belongs to a different diagnostic test entirely.
Makes sense.
Okay.
Now, let's talk about the currency, because the standard throws around terms like functional currency and presentation currency, which sounds like jargon.
It does, but it's actually pretty straightforward when you break it down.
Let's translate it out of the textbook. Like, if you run a massive bakery operation in Mumbai, your primary economic reality is dictated by the local economy, right? You buy your flour in Indian rupees.
You pay your bakers in rupees, you sell your bread in rupees.
Exactly. So that rupee is your functional currency. It's the financial lifeblood of your day-to-day operations. And when you type up your annual report to show your investors, you present those numbers in rupees. That's your presentation currency.
That is a perfect visualization, and the standard locks down the functional currency to that primary economic environment to prevent companies from, arbitrarily switching currencies just to make their revenue look better.
Oh, like picking a currency with a favorable exchange rate just for the report.
Exactly. It stops that kind of manipulation. So, for our case today, the Indian rupee is the absolute baseline for both functional and presentation currency.
And any currency other than that functional currency is legally considered a foreign currency, right?
Correct. The moment this company touches a US dollar or a euro or a yen, that foreign currency introduces an entirely different set of complex accounting rules regarding exchange rate fluctuations. But for today, strictly rupees.
Perfect. And one final really critical piece of housekeeping before we dive into the actual numbers. We are unpacking an incredibly nuanced, complex application of accounting law today. So I need to make this clear. The views expressed in this deep dive are the personal professional views of the author of our source material.
Right, and they are not legally binding on you, the listener.
Exactly. They are not binding. Whether you are an auditor, a CFO, or an everyday investor, we strongly request that you seek the help of a qualified expert before taking any action, or refraining from any action based purely on the interpretations we discussed today.
Because financial decisions and audit sign-offs require tailored, highly specific counsel. What we are doing here is illuminating the mechanisms of the standards so you know exactly what questions to ask your advisors.
Perfectly said. Now, our source material for this entire teardown is drawn directly from the 206th edition of the GAAP Advisors Task Weekly newsletter.
Which is an incredible resource, by the way, authored by C.A. Manish C. Iyer, Director of GAAP Advisors.
Yeah, and it's published regularly on LinkedIn. They've actually crossed over 230 published editions till date. So if you are on LinkedIn, I highly recommend subscribing to that newsletter for free. It gives you a front row seat to these kinds of suo motu investigations.
And for our international listeners, don't tune out just because we are talking about Indian accounting standards.
Oh, that's a great point. This isn't just a local issue.
Not at all. The standard we are dissecting today in AS 109, dealing with financial instruments, it's perfectly mirrored in the international landscape. There is absolutely no difference between Ind AS and IFRS, the International Financial Reporting Standards, for the specific topic we're discussing.
So the logic, the rules, the verdict, it's all exactly the same.
Exactly the same. It can be applied by all entities following the IFRS framework, whether you're auditing a firm in Mumbai, London, or Toronto.
Okay, so I want to pause here and address the elephant in the room. Let's say I'm an everyday investor, right? I work hard, I save my money, and I buy shares in listed companies to, build my retirement. Why on earth do I need to care about the granular nuances of Ind AS 109?
It's a fair question. A lot of people think they don't need to look under the hood.
Right. Shouldn't I just look at the stock price and the top-line revenue? Why do I need to understand the plumbing of accounting standards?
Because the top-line revenue and the stock price are entirely downstream of those accounting standards. Reviewing a company's financial statements for Ind AS compliance is, frankly, the ultimate lie detector test.
The lie detector test. I like that.
It is. The stock market is largely driven by sentiment, press releases, narrative, but the financial statements are supposed to be the mathematical reality. Your entire decision-making process, whether to buy, hold, or sell those shares, is heavily dependent on the integrity of those numbers.
So if a company misclassifies an asset, even through some tiny, seemingly harmless loophole,
it can completely mask its true financial health. It masks profitability.
Let me give a real-world parallel to that for the listener. Think about the absolute obsession with EPS, earnings per share. Wall Street, Dalal Street, they live and die by the EPS.
Oh, absolutely. It's the golden metric.
Right. So if a company projects they will make, let's say, $1.10 per share, and they come in at $1.09, the stock can tank 20% in a single day. The pressure on executives to hit that exact number is unimaginably high.
And that immense pressure creates a massive psychological incentive for management to engage in earnings smoothing. They desperately want to show a beautiful, predictable, upward trajectory of profits.
They hate surprises. They despise volatility.
Exactly. So if they have an asset that swings wildly in value, making them look incredibly profitable one quarter and terribly unprofitable the next, they will look for literally any accounting mechanism possible to hide that volatility from the main EPS calculation.
Which means if you, the investor, don't understand these standards, you're reading fiction. You are looking at a smoothed-out, artificially stable chart, entirely unaware of the massive risks hiding just offstage.
That's exactly right. And this isn't just a problem for investors, by the way. Think about the auditors.
Oh man, the auditors. I always picture an auditor at like 2 a.m. in some sterile conference room, staring down a convoluted corporate structure.
Sweating over a spreadsheet.
Yeah, trying to figure out if the client is legally allowed to classify a weird mutual fund as equity. They are fighting a psychological battle against complex rules and, let's be honest, heavy client pressure.
That is the daily reality of the audit profession. And that is exactly where having the right tools becomes the difference between a clean audit and a catastrophic failure. When an auditor is staring down that complex structure in the middle of the night, they cannot rely on guesswork.
They need precedent, right?
They need precedent. They need documented proof of how a standard applies to a specific edge case, which is exactly why the GAAP Advisors issue repository is so vital.
Yes. Over at gabadvisors.com, it's essentially a cheat sheet for financial truth. An arsenal for auditors and finance professionals.
It really is. It hosts over 4,500 specific issues and their detailed responses on both Ind AS and Indian GAAP.
Over 4,500. That's a massive database.
It's invaluable because an auditor's job requires them to meticulously document exactly how they addressed a tricky application of a standard. They have to prove their rationale, and any person can register for free on the platform.
Register for free, and then what? They just search it?
They can search, but they can also submit their own specific confounding issues on Ind AS and Indian GAAP and get a detailed response delivered directly to their email inbox.
Oh, that's amazing. Directly to the inbox of the email registered with the site.
Exactly. It's extremely helpful, particularly for auditors who desperately need to document how they tackled a weird application issue. It protects the auditor, which in turn protects the entire financial ecosystem.
It's the safety net for the people whose job it is to be our safety net. I love that. So let's actually step into the shoes of that auditor right now. Let's look at this specific observation from this listed company's published financials.
Let's do it.
We are looking at a specific table in their notes dealing with investments. Set the scene for us. What are we looking at?
We are examining the balance sheet as of March 31st, 2019. The company has a detailed table breaking down its various investments. The upper sections of the table are actually quite standard.
The normal stuff.
Right. They list investments in the equity shares of other known companies, like NHPC Limited and Power Exchange India. Perfectly normal. Companies often buy shares in other companies.
But then my eye drops down to item Roman numeral 3, which has the incredibly vague label of others. And I feel like it's always the others category where the bodies are buried.
You're not wrong.
What exactly did they put in this bucket?
Under others, the company discloses an investment in the units of a mutual fund. Now, for our discussion, we'll just refer to it as the Small is Beautiful Fund.
Okay, the Small is Beautiful Fund. And what are the specifics?
They hold exactly 61,052,200 units, and the face value is listed at 10 rupees each.
Okay, so we have a massive holding in a mutual fund. The total carrying value they report on the table is 6.18 crores. Now, the quantity and the underlying value, that isn't really the issue here, right? They bought the units, they have the value.
Correct. The math of the value itself is fine.
The massive red flag is the column heading they decided to park the 6.18 crores under.
Right. The column is titled Designated at Fair Value Through Other Comprehensive Income, often abbreviated as FVTOCI.
Okay, I need to stop you right there, because to someone outside the accounting world, moving money from one column to another seems like rearranging deck chairs. I mean, money is money, right? If the company has 6.18 crores in value, who cares what the label at the top of the column says? Does it really change anything fundamental?
It changes everything about how the company's operating performance is perceived by the public. You have to understand the fundamental psychological difference between the main income statement, which is profit or loss, and other comprehensive income.
Okay, let's break that down. The P&L, the profit or loss, that's the main stage, right? That's what everyone looks at.
Yes. The statement of profit or loss is the immediate operational scoreboard. When you put a financial asset in the P&L bucket, which we call fair value through profit or loss, or FVTPL, any fluctuation in that asset's value hits the bottom line immediately. Immediately. So if the Small is Beautiful Fund has a terrible quarter and loses 20% of its value, that loss is instantly recognized as an expense in the P&L.
Oh, wow. So it drags down the net income right then and there.
It drags down net income, and crucially, it drags down the earnings per share.
And then the executives have to get on an earnings call with angry analysts and explain why their core profits tanked just because the stock market had a bad week. They look totally out of control.
Precisely. They look vulnerable to the whims of the market. Now, contrast that with other comprehensive income, or OCI. OCI is essentially a holding pen.
A holding pen. Or like an attic.
An attic is a great way to put it. It's an attic where standard setters allow companies to temporarily store certain specific types of gains and losses so they don't contaminate the main P&L.
So if an asset is in the OCI bucket and it loses 20% of its value, what happens?
That loss bypasses the income statement entirely. It skips the P&L and goes straight to the equity section of the balance sheet.
Wait, seriously? So the EPS isn't affected at all? The net income number that all the algorithms and day traders look at stays perfectly intact?
The EPS remains completely untouched by that specific market loss.
Wow. Okay, now I see why the OCI bucket is so incredibly tempting for management.
It's the ultimate shield. If you hold a highly volatile mutual fund, putting it in FVTPL means you're strapping your company's core earnings to a roller coaster. Putting it in FVTOCI means you get to unbuckle from the roller coaster.
You just hide the market volatility in the attic. You present this beautifully smooth, uninterrupted line of profit to the market, even if your investments are bleeding out behind the scenes.
Exactly. It completely alters the perceived stability of the company.
That is wild. So it's not a labeling error at all. It is a highly calculated presentation strategy to fundamentally alter the risk profile in the eyes of the public, which means The standard setters must have seen this coming. They couldn't have just left it up to the company to choose which bucket to use based on their mood, right?
Absolutely not. The standard setters are well aware of this temptation.
Let's open up Ind AS 109, Financial Instruments. What is the governing rulebook here?
The philosophy of Ind AS 109 is actually quite strict, and it directly combats this exact behavior. The foundational rule we have to examine is paragraph 4.1.4. The standard setters drew a very hard line in the sand regarding where financial assets belong.
I assume they want everything out in the open on the main stage, right? What does the rule actually mandate?
Paragraph 4.1.4 establishes FVTPL, the main stage, as the absolute inescapable default.
Default, meaning you go there unless you have a really good excuse.
Exactly. The standard dictates that a financial asset shall be measured at fair value through profit or loss. It places the burden of proof entirely on the entity. You are forced onto the main stage, exposed to the volatility of the P&L, unless you can prove through extremely narrow criteria that you belong elsewhere.
So the baseline rule is pure transparency. Show us the roller coaster. But obviously, our listed company found a loophole, or thought they did. They must have found an unless in that paragraph to justify shoving this 6.18 crore mutual fund into the OCI attic.
They attempted to leverage a very specific exception within that same paragraph, yes. The standard continues by stating that an entity may make an irrevocable election at initial recognition to present subsequent changes in fair value in OCI.
Okay, an irrevocable election. So you pick it and you can't change your mind later.
Right. But, and this is the absolute crux of the matter, this election is only available for particular investments in equity instruments.
Equity instruments. Okay, let's visualize this. FVTPL, the main profit and loss statement, is general admission at a massive concert. Everyone has to go there.
Good analogy.
And FVTOCI is this exclusive VIP lounge hidden in the back where you don't have to deal with the noise and the volatility of the crowd. But the standard setters put a massive bouncer at the door of the VIP lounge. And the bouncer is holding a very strict guest list.
And the only guests allowed inside are equity instruments.
Only equity instruments. So before we figure out if our mutual fund is on the list, we have to ask why the standard setters even created that VIP lounge in the first place. I mean, it wasn't to help companies hide bad trades, obviously.
No, not at all. It was actually a pragmatic concession for strategic investments.
Give me an example of a strategic investment. Why would a company need this exception?
Okay, imagine you are a major automobile manufacturer. You build cars, and you rely heavily on a specific, smaller company that manufactures a proprietary microchip for your engines.
Okay, a critical supplier.
Right. Now, if that chip supplier goes bankrupt, your entire assembly line halts. You can't sell cars. So to secure your supply chain and have some say in their operations, you buy, say, 15% of the equity shares in that chip manufacturer. You aren't buying those shares to day trade them or make a quick profit on the stock market. You are holding them strategically, probably forever.
I see the logic there. If the stock price of that chip supplier drops by $1 today and goes up $2 tomorrow, the auto manufacturer doesn't care. They aren't selling the shares anyway.
Exactly.
So forcing the auto manufacturer to report those daily stock market swings in their own P&L, that would actually give investors a false impression of the auto company's core business, which is selling cars, not trading stocks.
Precisely. The daily market noise of that strategic shareholding misrepresents the operational reality of the car company. Therefore, the standard setters created the OCI exception.
They say, look, if you are holding an equity instrument strictly for strategic non-trading purposes, you can make an irrevocable election to park those daily valuation swings in the OCI attic. It protects the integrity of the operating profit margin.
That makes perfect sense. It's for true long-term ownership stakes. But the bouncer's rule is absolute. To get into the VIP lounge, to get the OCI treatment, the asset you're holding must be an equity instrument.
No exceptions.
Which brings us to the central diagnostic question of this entire suo motu review by Gap advisors. We have 6.18 crores sitting in units of the small is beautiful mutual fund.
Right.
Is a mutual fund unit actually an equity instrument? I have to admit, my initial instinct just as a layperson is yes.
And why is that?
Well, a mutual fund aggregates cash from a bunch of people and buys equity shares in dozens of small companies, right? That's what a mutual fund is. So since the fund is just a basket of equities, the unit I buy must logically be an equity instrument by extension. Doesn't it just pass through? That is perhaps the single most common logical assumption made by both amateur investors and even seasoned accountants.
Okay, why?
But it is completely fundamentally incorrect under the Ind AS framework.
Really? Not an equity instrument at all.
No, a unit of a mutual fund is absolutely not an equity instrument. It falls under a completely different technical classification known as a puttable instrument.
A puttable instrument.
Right.
Okay, we are diving into the deep end of the accounting glossary now. Let's break down the mechanics of this because I think this is where the entire house of cards collapses for our listed company. What makes a mutual fund unit fundamentally different from a direct share of a company?
It comes down to the underlying contractual obligations attached to the piece of paper you hold. Let's go back to our automobile manufacturer.
Okay.
If you buy one single share of that auto company, you hold true equity. You own a microscopic residual fraction of their net assets.
Right. I'm an owner. I share the ultimate risk with them.
But crucially, look at what you cannot do. You cannot walk into the headquarters of the auto manufacturer, slam your share certificate on the receptionist's desk, and legally demand that they open the cash register and refund your money.
Of course not. If I want to cash out, I have to go to the secondary market, the stock exchange, and find another investor willing to buy my share. The auto manufacturer owes me nothing. They have no obligation to hand me cash.
Exactly. That lack of obligation to deliver cash is what makes it equity. Now, examine the legal structure of mutual fund.
Okay.
When you buy a unit in the Small is Beautiful fund, you are not just buying a residual interest. You are purchasing a specific, powerful contractual right. You hold the right to put that unit back to the issuer, the mutual fund itself, at a time of your choosing.
Oh. So if I wake up on a Tuesday and decide I want my money, I log into my portal, I hit redeem, and the mutual fund is legally forced to wire the cash equivalent of the net asset value directly into my bank account.
Yes, it is effectively a refundable ticket.
Wow, a refundable ticket.
And that refundable ticket feature triggers a massive paradigm shift in accounting. Because the mutual fund has an unavoidable legal obligation to deliver cash back to you upon demand, the instrument you hold fundamentally meets the definition of a financial liability for the fund.
Wait, really? A liability?
Yes, it completely fails the definition of equity.
This is a spectacular plot twist. The very feature that makes mutual funds so incredibly popular with everyday investors, their ultimate liquidity, the comfort of knowing you can cash out at any second, is the exact same feature that mathematically disqualifies them from being true equity.
It's ironic, but yeah.
Because I can demand a refund, the mutual fund effectively owes me money. Therefore, from an accounting perspective, it is a liability.
The inherent inescapable DNA of a puttable instrument is a financial liability. It possesses a contractual obligation to transfer cash. Therefore, it can never fundamentally be an equity instrument.
Hold on, though. I'm playing detective here, and I've been reading ahead on the rule book a bit.
Oh, have you? Let's hear it.
Yeah, if we dig deeper into the standards, specifically Ind AS 32, which governs the presentation of financial instruments, there seems to be a glaring contradiction.
You found paragraphs 16A and 16B.
I did. I'm looking right at paragraphs 16A and 16B of Ind AS 32. These paragraphs outline a highly specific exception that explicitly allows a puttable instrument to be classified as an equity instrument.
They do say that.
I need you to explain this, because if Ind AS 32 says a puttable instrument can be called equity, doesn't that completely justify what our listed company did? Didn't they just use this exception and get past the bouncer and into the OCI VIP lounge?
This is where we separate the amateur hour from expert-level financial reporting. It is a brilliant observation, and frankly, it is the exact trapdoor that countless preparers of financial statements fall through.
So they fell for it.
Oh, completely. To untangle this contradiction, you have to profoundly understand the perspective from which the accounting standard is written.
Perspective. Are you saying the standard changes based on who is reading it?
Let's run a thought experiment. Look at this transaction purely from the perspective of the issuer. The Small is Beautiful mutual fund itself.
Okay, I am the mutual fund.
You are the ones creating and selling these units. If the mutual fund followed the strict, unyielding definition of liability versus equity that we just discussed, what would your balance sheet look like?
Well, if every single unit I issue has that put feature, that right to a refund, then every single unit is technically a liability.
Right.
So my balance sheet would be 100% liabilities and 0% equity.
Exactly. And what happens when an entity has massive liabilities and zero equity?
Mathematically, their net worth is zero. They appear technically insolvent on paper. even if they are managing billions of dollars in highly profitable liquid assets?
Exactly. If standard setters forced mutual funds to classify all their units as liabilities, it would completely break the accounting model for the entire mutual fund industry. No one would invest in an entity that looks perpetually bankrupt.
Ah, I see the dilemma now. The standard setters created a rule so strict it accidentally destroyed an entire sector's balance sheet, so they had to invent a fiction to save them.
It is a purely pragmatic carve-out. Paragraphs 16A and 16B of Ind AS 32 were written as a lifeline exclusively for the issuer. The standard setters essentially said, okay, mutual fund, we know these puttable units are technically liabilities because you owe cash, but to prevent your balance sheet from looking absurd, we will allow you, the issuer, to classify them as equity instruments in your own financial statements, provided you meet some very strict conditions.
Let me make sure I am grasping the boundaries of this lifeline. Think of the mutual fund like a massive casino.
The casino, all right.
To the casino, the issuer, the plastic chips moving around the tables are just internal tracking tools. They have a special regulatory exception that lets them account for those chips on their own books in a unique way so their internal math works out and they don't look insolvent to the Gaming Commission.
That's a great way to look at it.
But to me, the player, the person holding that plastic chip, I don't care about the casino's internal accounting exceptions. To me, that chip represents cold, hard cash that the casino is legally obligated to hand over when I walk up to the cashier's cage.
Right.
To me, it is a liability they owe me.
That is an exceptional visualization, and that visualization exposes the fatal error made by our listed company.
They use the casino's rules.
Yes, the exception found in Ind AS 32 is completely stationary. It only changes the classification from the perspective of the issuer, the casino. It does not change the inherent DNA of the instrument. It does not travel with the asset.
So when our listed company, the holder, the player at the table, looks at their investment in the Small is Beautiful fund, they are not allowed to use the mutual fund's special exception.
They absolutely cannot. For the holder of the instrument, the mutual fund unit remains exactly what it fundamentally is, a financial liability of the fund. It is unequivocally not an equity instrument from the perspective of the company holding it.
Which brings the entire logic train crashing back into Ind AS 109. Let's go back to the VIP lounge.
Let's do it.
The listing company walks up to the bouncer at the FVTOCI lounge holding their mutual fund units. They point to the Ind AS 32 exception and say, look, it says equity right here in the rulebook.
And the standard setter bouncer looks at the unit, identifies the put feature, recognizes that the exception only applies to the issuer, and says, to you, this is a puttable instrument. It is a liability. You are not holding an equity instrument. Access denied. You must go to the general admission FVTPL stage.
The verdict is absolute. The option to make an irrevocable election to designate this investment at FVTOCI is completely legally unavailable to the company.
Unavailable, period.
The units of the Small is Beautiful fund must be classified and subsequently measured at fair value through profit or loss. Any fluctuation in that 6.18 crore value must hit their immediate bottom line. The company has flat out failed to comply with the bedrock measurement standard.
It is a massive diagnostic finding. They took an asset subject to market volatility, illegally applied an issuer-only exception to themselves, pretended it was a stable strategic equity investment, and hid its fluctuations in the OCI attic, all to protect their reported earnings per share.
It fundamentally distorts the risk profile presented to the user.
Completely distorts it.
And what blows my mind is that this is only half the battle.
Oh, we're just getting started.
We spent this entire time dissecting the mathematics, the quantitative failure under Ind AS 109. But the suo moto review by Gap advisors uncovered something even more insidious on the qualitative side.
Yes, the narrative side.
Let's shift gears and look at Ind AS 1. That's the standard governing the presentation of financial statements. Because the real crime here isn't just that they put the number in the wrong ducat. It's the absolute silence that accompanied it.
You've hit the nail on the head. A financial statement is not meant to be a raw data dump. It is supposed to be a coherent, transparent communication from management to the stakeholders.
It tells a story.
Exactly. If the numbers are the skeleton of the company, the narrative notes are the muscle and skin that give it shape, context, and meaning. Ind AS 1 mandates that this narrative must exist.
Our source text points us directly to paragraph 112C of Ind AS 1. Break down the philosophy of this specific mandate. What does the standard demand of management here?
Paragraph 112C is essentially an anti-secrecy clause. It demands that the notes to the financial statements shall provide information that is not presented elsewhere in the financial statements but is relevant to an understanding of any of them.
Relevant to an understanding.
Right. It means you cannot just drop an anomalous number onto a page and walk away. If you make a specific election, especially an irrevocable one that alters where volatility is reported, you are required to provide the narrative context so the user can understand the rationale behind the math.
Relevant to an understanding. That phrase is the missing link in our specific case. Let's look back at the X-ray of the balance sheet. The company took the 6.18 crore value of the Small is Beautiful fund and dropped it into the FVTOCI column. But if you scan the rest of the document, there is absolutely zero explanation.
Nothing.
There's no accompanying note. There is no paragraph explaining their rationale, no mention of why they thought a puttable mutual fund qualified as an equity instrument. It is just a number sitting in a column it legally does not belong in, surrounded by complete silence.
And that silence is incredibly destructive. In the realm of financial reporting, silence forces the user to fill in the blanks with assumptions.
If I am an analyst reading that table, I see the OCI label. Because I generally trust the regulatory framework, the company's management, and the auditors who signed off on it, my brain automatically fills the silence with an assumption of compliance.
Of course it does.
I assume, well, they must have followed the rules. This mutual fund must somehow have a bizarre structure that qualifies it as a strategic equity investment. The silence actively tricks me into assuming the asset is low risk.
Precisely. Silence operates on the assumption that the user will simply accept the geography of the numbers without questioning the underlying mechanics. By failing to provide any narrative on the reason for designating these investments at FVTOCI, the company has erected a wall.
They made it impossible to verify.
Exactly. They made it impossible for a user to evaluate whether that choice was legitimate or, as our deep dive has proven, entirely flawed. This lack of explanation constitutes a direct secondary non-compliance, violating the core tenets of Ind AS 1.
It's infuriating. It is like the home inspector finding the rotting foundation, categorizing it as rustic charm, and then refusing to write a single sentence about what the charm actually looks like. It renders the entire report useless.
It does.
And this brings us to a really powerful, almost philosophical concept embedded within the accounting standards. I want to talk about Ind AS 1, paragraph 7. This paragraph formally introduces a concept called obscuring information.
Paragraph 7 is one of the most critical guardrails in the entire Ind AS framework. The definition of obscuring provided by the standard is chillingly precise.
Read it for us.
It states, information is obscured if it is communicated in a way that would have a similar effect for primary users of financial statements to omitting or misstating that information.
Let me stop you, because I really want that to sink in for you, the listener. The standard setters have mathematically and legally equated hiding something in plain sight with outright lying.
Yes.
They are saying that confusing the reader has a similar effect to completely omitting the data.
Absolutely. The standard is looking entirely at the end result from the perspective of the user, the investor deciding whether to risk their capital.
Wow.
If management provides the raw data, but they bury it so deep in the footnotes or confuse it so thoroughly with jargon and misclassification that the investor cannot comprehend the reality of the risk, the outcome is exactly the same as if management had committed fraud.
Because the decision the investor makes is just as broken.
Exactly. The resulting financial decision made by the investor will be equally impaired.
That completely destroys the classic corporate defense of, well, Your Honor, the number was technically disclosed on page 142 in footnote 8b. The standard is saying it doesn't matter if it's on the page if a reasonable person cannot decipher it.
That defense is dead on arrival under Ind AS 1.
To help auditors and regulators spot this behavior, the source text walks through specific examples provided in paragraph 7. I like to call these the 5 deadly sins of obscuring.
5 deadly sins. I like that.
Let's walk through these because they are fascinating tactics. What is the first sin?
The standard provides 5 clear behavioral examples of circumstances that result in material information being obscured. The first, point A, occurs when information regarding a material item, transaction, or other event is disclosed, but the language used is vague or unclear.
Ah, the weaponization of corporate jargon.
Exactly.
Instead of writing, we lost $50 million because our new product exploded, they write, the company experienced synergistic recalibrations of downward revenue trajectories amidst unanticipated thermodynamic product lifecycle events.
That is hilarious, but painfully accurate.
It is technically true, but the language is designed as a shield to repel understanding.
Using complexity to hide simplicity, that's the first sin. The second sin, point B, is when information regarding a material item is scattered throughout the financial statements.
Scattered. Okay, we will come back to this one because I think it is the smoking gun for our specific mutual fund case. What is the third sin?
Point C involves inappropriate aggregation. This is when dissimilar items, transactions, or other events are inappropriately aggregated or lumped together into a single line item.
Oh, I see this all the time in tech. A company has a highly profitable enterprise software division printing money, but they also have a bleeding cash experimental hardware division that is a total disaster.
Right.
Instead of showing them separately, management lumps them together under one single line item called technology revenue. They use the massive profits of the software to completely mask the catastrophic failure of the hardware. The user sees a positive number and has no idea half the company's on fire.
That is a perfect example of masking the bad with the good. Point D is the exact inverse of that. Inappropriate disaggregation.
Disaggregation, so breaking things apart.
Yes. This is when similar items are broken apart so completely that the user loses the big picture.
Death by 1,000 cuts.
Mm.
Imagine a company has a massive, terrifying $1 billion pending lawsuit. Instead of showing one terrifying line item, they break it apart into 50 different tiny, seemingly harmless legal provisions scattered across different subsidiaries.
So no single line item triggers an alarm bell.
Right. And the user never realizes the aggregate threat could literally bankrupt the company.
It's a classic misdirection tactic. And finally, point E. The understandability of the financial statements is reduced as a result of material information being hidden by immaterial information, to the extent that a primary user is unable to determine what is material.
I call this the needle in the haystack strategy.
It really is.
The company knows they have to disclose that the CEO is under investigation by regulatory authorities. But instead of making it a clear note, they bury that one vital sentence in the middle of 30 pages of incredibly dense, mind-numbing disclosures about the depreciation schedules of the office furniture and the stationery budget.
They flood the user's brain with so much useless, immaterial data that the vital data is lost in the noise.
Weaponized volume. Now, let's take these 5 sins and apply them to our specific case of the smallest beautiful mutual fund. We already established they put the 6.18 crore value in the wrong column, and they provided no narrative note alongside it explaining why.
Yes, the silence.
But let's play devil's advocate. Let's give the company's management the absolute maximum benefit of the doubt. Let's assume that somewhere, buried deep in Note 47 on page 200 of the annual report, there is actually a tiny sentence that says, "We classified the mutual fund as FVTOCI because we utilize a specific internal interpretation of the rules."
Okay, let's assume they did that.
Even if we assume they wrote that, what is a problem under Ind AS 1?
The problem immediately falls under point B, information scattered throughout the financial statements. Even if we assume that highly defensive posture, the company critically failed to implement a cross-reference.
A cross-reference.
Yes. In the main table under Note 11, where the 6.18 value is listed in the OCI column, there is no footnote marker. There is no asterisk. There is no parenthetical stating, "See Note 47 for explanation of fair value designation."
So the reader is just left staring at a disconnected number, completely untethered from any potential explanation.
Yes. Without a proper direct cross-reference connecting the mathematical number on page 50 to the narrative text on page 200, the information is effectively scattered to the wind. The reader is forced to play a blind guessing game, hunting through hundreds of pages of complex, dense legal documents trying to link a standalone anomalous number to a potential hidden explanation.
And let's be honest about human behavior. The vast majority of investors, and even some overworked analysts, simply won't do that. They don't have the time, the patience, or the technical expertise to hunt for ghosts in a 300-page document.
They won't. They'll look at the main table, see the OCI label, assume the asset is stable, and move on.
They remain completely misinformed about the actual volatile risk profile of the asset.
Therefore, the presentation actively and successfully obscures information. By the standard's own rigorous definition, this presentation has a similar effect to omitting the information entirely. It finalizes their non-compliance.
It is a dual failure.
A massive one. They failed Ind AS 109 quantitatively by misclassifying a puttable liability as an equity instrument, and they failed Ind AS 1 qualitatively by failing to explain it and actively obscuring the reality from the primary user.
It is a spectacular double failure. caught purely by the Gap advisors team, taking the time to suo read the document critically, challenge the assumptions, and understand the underlying contractual nature of a puttable instrument.
It's an incredible piece of detective work.
It really is, but honestly, as an investor, it leaves me feeling a little terrified.
It should instill a healthy sense of skepticism, frankly. It highlights a crucial point about systemic risk in our financial markets. Think about the gravity of this. If a publicly listed company, audited by professionals, misclassifies a simple mutual fund unit, a standard, everyday investment that millions of retail investors hold and understand, and then completely fails to provide the basic narrative transparency to explain it, what else might be obscured in the genuinely complex, opaque areas of their financial statements?
That is the terrifying question. If they are burying mutual funds in the attic, what are they doing with complex derivative contracts?
Exactly.
How are they structuring their off-balance sheet financing? What massive existential contingent liabilities have they broken apart using inappropriate disaggregation? If the foundation is rotting where we can see it, what does the plumbing look like behind the walls?
And that is precisely the thought we want to leave you with today. As an investor or as a professional operating in this space, your greatest asset isn't just your available capital or your spreadsheet skills. It is your ability to demand clarity.
Never accept silence.
Never. If the bones of the financial statement look murky, if the x-ray is blurry, you have every right, and frankly the obligation, to ask why. You cannot accept silence.
And if you are on the other side of the table, if you are the one building the house, you cannot afford to let these errors slip through. This is exactly why the preventative review services provided by Gap advisors are so unbelievably critical.
Before those financial statements go out into the public domain, before they are published on the stock exchange and scrutinized by regulators, they need an independent expert review.
It is the ultimate preventative measure. If you are a CFO, an auditor, an audit committee member, or anyone responsible for signing off on financials, you must ensure compliance before the ink dries. Get your financial statements reviewed by Gap advisors before signing them.
It's the smartest insurance policy you can buy against reputational and regulatory disaster.
And it's so easy. You don't even have to leave your desk. You can submit your financial statements in near-to-publishing PDF format directly by email to info@gapadvisors.com. Let the experts run the high-definition X-ray and find the misclassified puttable instruments before the public or the regulators do.
Conversely, if you happen to invest your hard-earned money in a listed company's shares, relying on a professional, independent review of the company's financial statements for strict Ind AS compliance can radically empower you. It helps you make a proper, mathematically informed decision on buying, holding, or selling those shares, completely removing the narrative guesswork.
It pulls you out of the diagnostic muddy waters and puts you on solid ground. Now, we've covered massive ground today, from the philosophy of FVTOCI to the 5 deadly sins of obscuring information.
We really did.
If today's deep dive sparked a specific burning question for you, or if you are currently grappling with your own complex, mind-bending Ind AS or IFRS issues at work, you do not have to struggle in silence. You can actually book a one-on-one consultation directly with the author of today's incredible source material, C.A. Manish C. Iyer.
He is a wealth of knowledge.
He really is. You can find his profile and book dedicated time with him on topmate.io.
Furthermore, the regulatory landscape we've explored today is not static. It is constantly evolving. To stay continuously updated in this rapidly changing environment, we highly recommend that you follow the Gap Advisors Ind AS Clinic channel on WhatsApp.
That's right, on WhatsApp.
It is an invaluable feed that provides instant updates on all new videos, audio deep dives, newsletters, new issues that have been solved and added to the repository, and, crucially, immediate alerts whenever new accounting standards are issued or amended.
It is simply the easiest, most efficient way to keep your finger directly on the pulse of financial reporting. And finally, we have a huge request from our side. If you found value in the teardown we performed today, if it changed the way you look at a balance sheet, please share this audio deep dive among your professional network.
Send it to your contacts, share it with your colleagues, drop it into your audit team's group chat, and send it to your finance departments.
We especially urgently request you to share this specific deep dive with students who are currently pursuing the CA course.
Yes, the students. They are the future gatekeepers of our financial integrity. They are the ones who will be fighting these battles at 2 AM in the coming decades.
Exactly. Spreading the vital, practical, unvarnished knowledge of Indian accounting standards is absolutely essential for the long-term health and transparency of our capital markets. Help us arm the next generation of financial doctors.
Well said.
Thank you so much for dedicating your time, your focus, and your intellect to learning with us today. We know these technical topics are dense, but unpacking the mechanics of reality together is incredibly rewarding.
It really is. Thank you all for joining us.
As a final ask, please follow or subscribe to the Gap Advisors Ind AS Clinic podcasts on Spotify, Amazon Music, or YouTube, whichever platform you prefer to listen to the Gap Advisors Ind AS Clinic podcasts on. We will be back soon with another extensive deep dive, bringing you more vital clarity from the complex world of accounting standards. Until then, never accept the other's column at face value, and always, always keep questioning the numbers.